As we heard earlier, the correction in the Nikkei in the past few days put some wobbles through markets. But around the world, central banks are rethinking their approach to austerity in favour of growth and, interestingly, their tolerance to higher inflation. Well, that's the view of the former Reserve Bank board member and ANU's Professor Warwick McKibben, recently back from overseas. I caught up with him a little earlier. Professor Warwick McKibben, welcome to the programme.
Hello, Tiki. Nice to be here again.
Yeah, good to be here again. A few developments since we spoke in March. You're just back from the United States, and I understand you've sensed a real shift in thinking from central banks.
Well, yeah, just talking to people privately, there seems to be a shift away from the focus on absolute austerity as a way of reducing government debts to maybe allowing a bit more inflation in the global economy to get the ratio of debt to nominal GDP to come down through a longer process.
Now, when you say a bit more inflation, I mean, what sort of comfort zone are we talking about? Because we know banks are looking at growth and easing more.
Well, the focus traditionally on inflation targeting central banks has been 2 to 3% inflation, but there are starting to be studies coming out now looking at the impacts of 6, 7, 8% inflation and how it's not bad for equity markets to have a rising inflation to that extent, and that enables you to avoid as much austerity as would be required to get the enormous government debts down relative to GDP.
So 6 to 8%. I mean, that given the time that we're sitting between these comfort bands, as you say, of 2 to 3%, that does sound very high.
Well, it is, and it's worrying to me because I believe that inflation is a bad thing for the economy. But on the other hand, if you look at history, it has been inflation which has ended up reducing government debts when governments have lost control of their fiscal positions. And it's hard to imagine ultimately that this isn't going to be the same as most of history.
How do you think Australian policymakers would get their heads around those sort of numbers?
Well, it makes it difficult for the central bank because if the rest of the world is starting to run higher inflation than Australia, then that would lead to a steadily appreciating exchange rate in Australia, and that's a very uncomfortable situation, and in part explains the current strong exchange rate in Australia, the differentials in monetary policies across the world.
I'll come back to the dollar in a minute, but while we're on this easing issue, what do you make of what is going on in Japan and this great Abenomics experiment? Because that, if you like, is the extreme end of easing and stimulus, and yet the wheels appear to be coming off with this equity correction and these 10-year bonds spiking.
Well, it's actually a very interesting experiment. We modelled it a decade ago for the Japanese government, and it can be very successful, but it can also be very dangerous. What's critical if you are going to inject as much money as they're injecting into the economy and spending even more government spending is that you have to have a very clear plan for future reduction in government debt. If you don't have that clear plan, then wheels will start to come off as long-term bond rates start to rise. It's absolutely critical that the fiscal positions in the future are seen to be improving, and that keeps real interest rates low and stops nominal interest rates from rising too sharply.
So how do you think this is going to pan out? Because at the moment it doesn't look as though they have got a handle on bringing down that debt.
Well, again, there are three parts, three arrows in the policy. One was monetary stimulus, which they've done. Second was fiscal stimulus, followed by consolidation. They've only done half of that, which is suspending. And the third is serious structural reform in the economy. And as far as I'm aware, that has not yet been through the diet. So it's a bit tricky not to do them all together, and it's a bit dangerous to do it in the sequencing that they're doing it. But this will be a great experiment for the rest of the world. If it succeeds, then the US and Europe are likely to follow suit, particularly Europe. If it fails, then they're going to have to come up with an entirely new strategy globally.
Back to Australia, what do you make of our recent falling dollar?
Well, it's actually falling because people are starting to shift out of the portfolios that make Australia very attractive. And I think part of it is, as I spoke to you previously, the recovery in the United States is actually moving along quite well, and that's partly an energy boom and partly other parts of recovery from the policies that the governments have put in place. But that means that capital will relocate away from Australia back into the US. That portfolio shift will be good for our manufacturing sector, and it will bring things back to closer to fundamentals, which are probably, given our terms of trade, around 85 to 90 cents rather than over $1.
So how do you see the Reserve Bank at the moment factoring this lower dollar into their deliberations on rates?
Well, it's good news for the real economy in the sense that it does help with Australian exports. It, however, does hurt the inflation target because non-traded goods prices are running at around 3.5%, and the exchange rate has been holding down traded goods prices. Once that effect is gone, we'll start seeing inflation on Australia rising back above the band. Then the question, coming back to our earlier conversation, the question has to be, do we stick to the inflation target or do we move to a nominal GDP target, which is actually my preferred way of implementing monetary policy.
So do you see a move on rates for the rest of the year?
Well, I think the bank was moving towards cutting rates again. I don't think they should, and I'm not sure that they will. A lot will depend on what data comes out over the next few weeks. We still have Europe on the precipice of a very serious problem, and that's always hanging in the background. But so far, the bank's managed it extremely well, in my view.
Warwick, the big news last week, of course, was Ford pulling out of Australia. We've now got the Resources Minister, Gary Gray, talking about very high costs too in the gas sector. Are we stuck with a high-cost economy, do you think?
Well, we are stuck with a high-cost economy. If you look at right across the board, we've got, in terms of labour costs, in terms of energy costs, regulatory costs, this is an economy that's been becoming increasingly uncompetitive on the input side, and the strong exchange rate has just made it even worse. But it's really the input costs which you need to deal with, and you can either deal with that through changing regulation, changing policies directly, or through more enhanced productivity improvements. And I just don't see that sufficient has been done to raise productivity growth in this country at this stage of the cycle.
We've also, for the first time, got this new structural budget analysis now available to us. Does that help, do you think? And where do you see the vulnerabilities now in the economy?
Well, it's actually very difficult to calculate the structural budget position, but it's a very important thing to do. And it is clear that we've drifted into structural deficit over a long period of time. My view is that we've got to be very careful not to mix up the importance of capital expenditure, that is infrastructure investment, which has a very high rate of return if done properly, and funding current expenditure out of current taxes. We need to shift the economy back into a much better fiscal position on the current expenditure, but still invest heavily on the capital expenditure to raise private sector productivity. And the only way to do that under the current fiscal environment is to issue long-term infrastructure bonds. I don't see that happening given the fixation with the fiscal position overall, but that really is what we should be focusing on in this economy at this stage.
A lot of moving parts. Professor Warwick McKibbin, it's always great to catch up with you. Thank you.
My pleasure, Tikki.